If your history lessons taught you well, you know the possible downside of investing. It is not a matter of if there is a correction. It is just a matter of when. The Great Depression 1929 to 1939 was the most severe economic crisis in U.S. history, characterized by widespread unemployment, bank failures, and a decline in industrial production. The Long Depression 1873 to 1879 was a prolonged period of economic contraction triggered by the collapse of the Vienna Stock Exchange. The Panic of 1907 was a severe financial crisis that led to bank runs and the establishment of the Federal Reserve System in 1913. The recession of 1981 to 1982 was a sharp economic downturn characterized by high inflation, high interest rates, and a significant increase in unemployment. The Great Recession 2007 to 2009 was a global financial crisis that originated in the U.S. housing market and led to widespread bank failures, stock market declines, and a severe recession. The U.S. has also experienced smaller recessions, such as the early 1990 recession, the dot-com bubble burst in the early 2000s, and the COVID-19 recession in 2020. Market corrections, such as the S&P 500's 36 double-digit drawdowns since 1950, are common and part of the natural ebb and flow of the stock market. Bear markets, more severe and less frequent than market corrections, have occurred about once every 7 years since 1950. There was a market reaction to change United States credit ratings of the USA. Fitch, AA+ with stable outlook, Standard & Poor's, AA+ with stable outlook, and Moody's, AAA with negative outlook. There are things that can help you minimize losses and navigate these challenging times. You heard it before. Diversify your portfolio. Spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. Diversification can help mitigate risk because not all assets move in the same direction during market downturns. Next, consider use of what is called defensive investments. These are assets that are less susceptible to stock market volatility. Examples include bonds, dividend-paying stocks, and precious metals. Defensive investments aim to limit risk exposure. During market turbulence, emotions take over. Avoid making panic moves, as they often lock in losses and prevent you from benefiting from future gains. Remember that corrections are part of the natural market cycle, and overreacting can harm your long-term returns. Panic selling at a loss can hurt you. Also, you should hit the like and subscribe button at this time. We are not done. Do it while you are thinking about it. Assess your expenses. Check your expenses and create a budget. Increasing your savings and building an emergency fund equivalent to about 6 months' worth of living expenses can provide a safety net during tough times. It also may keep you from selling at a loss. Invest for the long term. Focus on investments that increase in value over time. Recessions may offer opportunities to acquire assets at lower prices. Stay committed to your investment strategy and avoid knee-jerk reactions. If you are doing long-term investing, then recovering from a dip happens before you hit what is called your investment horizon. In the meantime, you are picking up shares at reduced price. Use leverage tax advantages such as tax loss harvesting. This involves selling losing investments to offset gains and reduce your tax liability. Additionally, explore tax deductions related to owning real estate property. Remember that no strategy can completely eliminate risk, but thoughtful planning and staying informed can help you weather market downturns more effectively. Take a good look at your position and plan for the future. Please like and subscribe to this channel.